Hello, I'm Barbara Ash, National Director of the Veteran Institute for Procurement, and I would like to welcome and thank you for joining us for this VIP webinar, Indirect Rates, What You Need to Know. This webinar was developed with the goal to help you to accelerate your growth in the federal marketplace. And that is what VIP is all about, accelerating the success of veteran-owned small businesses that are government contractors. And it is working. On average, companies grow 54% just 1 year after graduation from the VIP program. VIP offers 3 different curriculums to give veteran-owned small businesses the tools they need to win government contracts. Programs are held in the Washington, D.C. area, just 11 miles from the White House. Participants receive hands-on, market-based instruction that helps establish best business practices for federal government contracting. And the program is offered at no cost to veterans nationwide. We currently offer VIP Grow, our core curriculum, VIP Start for veteran-owned small businesses looking to become procurement ready, and VIP expanded its curriculum and now offers VIP International to accelerate veteran small business success in the global marketplace. This webinar series is made possible thanks to the support of the Small Business Administration. Its goal is to provide resources to the 20 veteran business outreach centers located throughout the country that support veteran-owned government contractors with entrepreneurial development, such as business training, counseling, and mentoring. And is also a resource to our VIP alumni to ensure their continued success in the federal marketplace. The slides and audio from this webinar will be made available on the VIP website at nationalvip.org. It is now my pleasure to introduce our leader in her field, Donna Dominquez. She is experienced director with Aronson LLC and a VIP instructor. She has demonstrated a history of supporting the government contracting community. She supports her clients from negotiating teaming agreements, developing competitive rates, bidding on cost proposal, establishing an adequate accounting system, invoicing and managing the contracts, to supporting government audits and contract closeouts. Donna, thank you so much for joining us today.
Thank you so much, Barbara, for that lovely introduction and for having me here today. I'm very excited to talk to you guys about indirect rates. There's a lot to know, so hopefully we'll get started here and just jump right on in. Please feel free to ask your questions in the question box if you have any questions as we go through today. I will try and answer them as we go through today's webinar. Any questions I'm not able to answer through today's webinar, I'll respond via email later on to you. Okay?
Great, thank you.
Thank you. All right, so let's go ahead and just jump right on in. So today's topic, indirect rates, I want to make sure that we all walk away with understanding how to calculate rates that could be held up during an audit for the government. So if you're doing proposal work and you have to do budget indirect rates, the government could come in and audit those indirect rates for you. So we want to make sure when we put our rates together, we do so with the thought that if someone needs to come back and look at it later, we're doing it correctly. We want to also make sure that we're designing indirect rates that make sense for us and for our businesses so that we grow and are successful and competitive in our space. So that also has to be a thought process. Not everyone's going to have the same indirect rate structure, and they're definitely not going to have the same indirect rates, even if you have the same structure. Part of also today's topics, we're going to go through and understand the different parts of the indirect rate, so we will walk you through them. I have examples that we're going to go through towards the end of the slide deck. Also, a key important thing is I find out a lot of times when we're starting out in the government contracting industry, we start out as a subcontractor. So we want to talk about what our pricing would look like, what we would show to our prime contractor, what we would show to the federal government. So there's differences in those, and we don't want to share our proprietary information. So we'll go through everything today, and we're going to jump on in and start out talking about budgeted indirect rates. So why are these important, and what is this? How is this going to be a benefit to me and to my business? Well, first we want to know that this is something that needs to be prepared on an annual basis. So I don't know if anyone's ever done a proposal, and let's say it was a base in 4 years. Those budget rates that you used for that proposal is not the same rate you're going to use every single year when you do the actual billings, because you're supposed to update your budget every single year. So and keep in mind, your budget indirect rate, your indirect rates really are, let me tell you the secret, it's your P&L. It's the expenses of the company, and we're taking all the indirect expenses and we're burdening it on top of all of our direct expenses so that we as a company get reimbursed all of our costs, both direct and indirect. So the idea is from year to year, your businesses are growing and changing. We're adding people. You're not going to look the same. You need to make sure you're preparing a budget on an annual basis so that it accounts for all the changes in the growth of your business. These rates will then be for company-wide, and you're going to use them for bidding on all of your federal awards or to your prime contractors. It will also be used for billing on cost reimbursement type contracts and time and materials when you have burdened the G&A on your pass-through costs. This is also important when you establish a budget. It gives you a baseline for where you're expecting your company to go for the year. The idea of developing a budget is your strategic plan needs to align with your budget indirect rates. So whatever your goals are for the upcoming year, you need to account for those costs in your budget. For example, let's say we're doing really well, we're going to grow, and we're going to move into a new office space, and it's a bigger office space. Well, those costs for the rent and the utilities, the office supplies, the janitorial services, all those costs are going to grow, and you need to account for them so that you get reimbursed those costs, so that we're still making money, right? And then we're growing, but accounting for all the cost of the business. Maybe I want to hire a few new indirect people. That all needs to be in your budget so that you can account for it and bill for it later. We're also going to talk about compensation for the owners, and I'll get into that in a few minutes here, but that's part of the budget. You need to account for what are you going to pay yourself as the owner of the business. You need to pay yourself so that you can get reimbursed those costs. You need to make some money too. We all need to pay our bills and we need to eat. So I want to make sure you're getting some money to pay for your bills. All right. So we're going to start off by going through definitions. This is the first thing I like to do whenever I do a presentation. That way, whatever terminologies I'm using, you guys are understanding what I mean by them so that we're all on the same page. And then we're going to talk about the different types of indirect rates and what's in the pool and what's in the base and how to calculate the rates. And then we're going to talk about different types of indirect rate structures. And then we're going to get into like the meat and potatoes of it. And I have examples of showing you how to do the cost buildup, how to do it when you're showing for a price proposal. And then what we're going to talk about, what we're going to show to the as a subcontractor, what we're going to show to the prime contractor, and what we're going to show to the government in a sealed bid. And as I stated earlier, please, if you have questions, go ahead and put them in the question box. I'm happy to answer all your questions. I'm here to help you. There's a lot of information, I know, but we'll get through it, I know. Together we will. All right, so definitions. We're talking about indirect rates today, but I want to take a moment to explain there's kind of three different types of cost in government contracting. There's direct cost, there's indirect cost, and then there's unallowable cost. So direct costs are those costs that are directly associated to a contract. I won an award and I have to put people on that contract to fill the scope of work. They're going to fill a specific labor category, and I know I'm going to put them in at level 1, 2, and 3. So I need these employees. They've got directions as to what they need to do. That's direct labor. It's a direct cost associated with the contract that I just won. But then there's indirect costs supporting that contract. There's the management of the business. There's the accounting department, contracts, all the other costs that's associated with running a business. Those are going to be in your indirect cost, and we'll get into the specifics in those in just a moment. And then there's such things as unallowable cost, and those need to be separated because you're not allowed to bill those to the government under the FAR regulations. The Federal Acquisition Regulations stipulate certain costs are not allowed to be passed through to the government. So you need to make sure that you're understanding which bucket your costs are going to go into so that you can account for them properly. And we're going to get into some more details and examples here. But what I want to make sure that everyone understands is when I say indirect cost pool and indirect cost base, I'm talking about basically essentially a fraction, a numerator and a denominator. I'm going to have a group of homogeneous costs, similar costs, that I'm going to pool together and put it in a pool that's going to be my numerator. And I'm going to allocate it over a causal beneficial relationship. So the denominator is the people that I'm incurring this expense for. So like what's causing me to incur this expense is who's benefiting from it. That's how we're going to get the fractional relationship. So the numerator and the base, you divide those and then you come up with a rate, and that's what we call our indirect cost rate. All right, now the indirect cost that I just mentioned a moment ago, I wanted to point out the actual FAR clause. So it's FAR 31205, selected cost. If you go to this link, copy it and paste it into your website, you will be able to go and find where all the selected costs are listed, and that'll help you determine whether the costs are all allowable, completely not allowable, or partially sometimes allowable. So having to have this link is a good sanity check. But my quick and easy way to figure out if costs are allowable, it's usually if it's fun, I can guarantee it's probably not going to be an allowable cost. For example, holiday parties. You know, everyone dresses up, we have drinks, we get to have great food, we're having fun, we are just enjoying ourselves. That's a fun, good time. Well, that cost is an unallowable cost. You know, we're going out for happy hour to celebrate a big win on a proposal. Alcohol is expressly unallowable. So it's fun, right? People are having a good time. That's an unallowable type cost. Now, there are some other costs that are not always so fun, but you have to look up under the FAR to figure out which costs are then allowable or unallowable. For example, if you're doing a bid protest, you're incurring accounting and lawyer fees associated with a bid protest or some type of mergers and acquisitions. Those are unallowable costs. So some not so fun costs, you can go look them up in detail, but anything you think is fun, birthday cakes, we're celebrating birthdays, having good times with giving out gift cards, those would all be unallowable costs. You can incur them, you just can't claim them in your rates. It's an expense that comes off of your P&L at the bottom, but not part of what we're going to calculate today. All right, so we're going to talk about wrap rates. Now, it's a term meaning a multiplier that I'm going to burden on my direct labor. So you might use the terminology loaded labor rate, fully burdened rate, fully loaded labor rate, a billing rate. All these things are ways of you applying the indirect rates onto a direct labor. So common in the industry is a multiplier or wrap rate. So I'll probably use those terminologies throughout today's discussion. All right, so let's talk about what these pools are and what they look like. I like to start out with Fringe. So Fringe benefits, if you think of it as kind of like if you had an employee handbook, what is in the employee handbook that you're offering as Fringe benefits? The Fringe Pool is going to be comprised of what we call statutory type costs and discretionary type costs. The statutory type costs are your FICA, FUTA, SUTA, and workers' comp. Your discretionary is I give holiday pay, I give PTO, vacation, I have 401k benefit, whatever your benefits are, those are discretionary. It's your choice to give them as the company as a type of benefit. And this is going to be typically allocated over the labor dollars that's incurring this. So all my employees, all of their labor will be in the base and all of my fringe benefit costs will be in the pool, and that will derive a fringe rate. Most companies will start out with a single fringe rate. Some will have nothing but a single fringe rate for the entire life of their business. And that's okay. It's fine. There may be reasons why somewhere down the road you might want to have more than one fringe rate. And that's oftentimes when people have SCA or Davis-Bacon type contracts where you have a wage determination sheet that tells you you're required by Department of Labor to pay this specific base pay and specific benefits. And for that reason, there's also reporting requirements. It's easier to segregate those into a separate fringe pool. So you'll do a separate fringe rate for those people. If you're a company with half of your employees full-time and half of them are part-time, and you don't offer your part-time employees any benefits, then you might want to have one fringe that's the statutory for everyone, and then have a second fringe rate that's the discretionary for only the full-time employees. This way, your part-time employees are not getting burdened with the discretionary costs because they're not eligible for it. They're not getting it. So you can kind of save on your part-time employees' costs that way. All right, here's an example. Let's go to this example here. And don't worry about like writing notes on this. You're going to get the slide deck at the end of today's webinar. Making sure that you kind of follow along and understand, maybe putting some side notes, but you will get all the slides after the conclusion of this webinar. After the recording is completed, it will be sent out to you automatically. Now, here's an example of a Fringe Pool. I put together dummy accounts and dummy numbers. And what you'll see here is I have in the 5,000 series all of my vacation costs, my holiday, my sick, and other leave. If you offer holiday and just PTO, then those are the accounts you would have. I have all my FICA, FUTA, SUTA. Some people just call them payroll taxes all together in one line item. That's okay too. In my example here, I've got 401k. I have health insurance, long-term life insurance, disabilities. Whatever you offer as a benefit, that needs to go here in the Fringe Pool. And if you look at the bottom here, I've got a $1.2 million total Fringe Pool number. Now I want you to follow that number onto this next page. So if you see up here at the top, you'll see the Fringe Benefits pool amount of 1.25 million is up here at the top, and it's going to be allocated over my total labor dollars. Now here is everybody's labor because Fringe goes to everyone. Now I've got it separated by the different types of labor accounts that I have set up. Overhead labor is the OH labor account, facility service center labor, G&A labor, B&P for bid and proposal labor, direct labor, and then I put here a direct labor / owner, and then a direct labor non-billable. The NB is for non-billable. Now I created a separate line for the owner. For those of you who have an LLC type entity or an S Corp, a pass-through entity, your owner, as the owner of the company, you're not getting a W-2, you're not getting a salary. But what we want you to do in government contracting is pay yourself, so the cost associated with paying yourself is going to be accounted for in your indirect rates. If you don't put it in there, you don't get to recover it. You're not paying yourself. So if we want the reimbursement of your compensation, we need to account for it in a guaranteed payment. And for tax, I was being nice to the tax accountants. I'm not a tax accountant anymore, but sometimes we like to separate the owner's compensation in a separate GL account. You don't have to. If you want to, sometimes the accountants just like it for ease of reporting purposes or being able to tell the tax accountants in a quick glance how much the owners were making. You can create a separate GL account for the owners under the different labor types. Now what we did is just took the $1.25 million pool amount and we divided it by the $4.4 million base, and that derived the 28.04% fringe rate. But if you look off to the right where it says allocations and you see the $75,000 and the $12,000, that's when you take the pool amount of $1.2 million, you can see how it's following the labor proportionate to the size and the dollar amounts of the labor. That's because we're burdening it with the fringe labor. It's following the labor. Now we're going to talk about overhead here. Overhead is probably the most complicated of all of these different indirect rates that we're going to talk about. It's harder to understand because it is the cost you incur supporting all your contract work, but it's not directly charged to your jobs. So a good example of this is a director of operations, or if you are the owner of the business is managing the contracts that you've won, you're managing the people on the contracts, right? We're signing off on their timesheets, we're approving leave, we're talking to the customer, we're making sure the customer's happy, we are managing the contracts and making sure everything's okay. Maybe we're talking back to the board of directors or to the owner and reporting back how the contracts are all doing. That's an overhead cost because it's supporting the contracts, but it's not charged directly to the contracts. So if you have overhead, and you don't have to have overhead labor, but if you do, you don't have to, if you have it, then you're going to have it because it's supporting your contracts. And then it's going to be allocated over a causal beneficial relationship. It's supporting the direct people, right? So it's going to be over direct labor and B&P labor because that charge code is for my direct folks. We'll get into that in a minute. And their fringe allocation. And I'll show you what it looks like here on the next one because it might be easier to follow here. So here's an example of overhead. The pool shows the overhead labor, and I created one just for the owner if they wanted to have a separate GL account for that. You don't have to. And then we have all the expenses following the overhead labor. So my director of operations or my COO or the owner of the business who does operational support as well as running the business, their time is going to be charged to the overhead labor account. So all the cost associated with supporting that time and effort that I'm doing overhead needs to follow in the pool. And so I've got the performance-based bonuses, any travel or business meals. If I go to any conferences for training, the cost associated needs to follow that person. If I'm sending direct or overhead people off to a conference to go do some training and learn, their expenses are going to follow them here in this overhead pool. Same with recruiting expenses. So most of our time we spend recruiting for direct employees. The expenses we incur to hire these people, to recruit them, needs to go here in the overhead pool because it's following the labor that I'm hiring. If I hire someone in the G&A bucket, then I want the recruiting expense to fall in the G&A bucket. But predominantly we are hiring for direct and overhead people. So the bulk of your recruiting cost will be in the overhead pool. All right, so there's a question, part-time employees under SEA, can we exclude leave, holidays, health and welfare, or is this only for non-SEA hires? So under SEA, it will tell you specifically for health and welfare what you have to offer. So a lot of times clients that have significant amount of SEA work, they'll create another fringe pool to account for those costs. You really need to go and look at your wage determination sheet to see what the requirements are for that. For your non-SEA hires, you would just give them whatever your original fringe benefit package is. You don't have to give them what's required under SEA. You'll just give them whatever it is you offer to any other regular employees. All right. Here's the example of my pool cost then being allocated over the base. So what I wanted you to see here was it's being allocated over the direct labor dollars, the fringe associated with that, and the B&P dollars. And then I'm coming up with 11.22% overhead rate. Now we're going to get into service centers here. Now I want you to keep in mind, service centers, you don't have to use them. They're just nice to have if you want them. It's a good way for you to group homogeneous costs and allocate them on a monthly basis. So once a month, I'm going to allocate my rent expenses, utilities, all that will be depreciation expense, property taxes to my overhead and G&A buckets. You don't have to use a service center. Accountants like them because it's less journal entries, but you can book your rent directly to directly to your G&A and overhead. You can take all your facility costs and do the same thing. You can book them each month directly into the overhead and G&A bucket, or you can use a service center and via journal entry or whatever your accounting system is, it will push it to the G&A and overhead pools. Here's an example of a facility service center. For example, if you had an office manager and an IT guy that worked in your office to help support the company as a whole, you know, they make sure that your phones are working, your internet's working. Anytime you have any IT issues, my IT guys know I need a lot of IT help. So their labor could go in the service center, and then it would be allocated to my G&A and my overhead. If you look down at the bottom in the yellow area, that's the base. So I'm allocating it on this example over labor dollars. So I've got G&A labor and overhead labor, and they're being allocated to their final cost objectives. So a portion of this $162,000 pool, 114 is going to go to my G&A pool, and 48,000 is going to go to my overhead pool. And this is just once a month. I sum up the total of those indirects, and then I can allocate it to those final cost objectives at the end of the month. Now, G&A in the government world is oftentimes looked at as contractors adding more fee on the work. Well, that's not true. It's the backbone of the business. This is running the business. Even if the contracts went away, I still have to do taxes. I still have to do my bookkeeping. All of the effort that you need to do to run your business is general administrative cost. So in here, if you're working on negotiating contracts, teaming agreements, NDAs, you're working with your external accountants to do your month-end reports, or if you're doing financial statements, all those costs associated with interacting and running the business, that's what we call G&A cost. And those are going to be allocated over the rest of the business, what we call total cost. So let me show you an example of that. So here, I hope you guys can see this. The G&A labor is in here, and then we have all the expenses following it, of course. Same thing again, performance-based bonus, travel, business meals, conferences and trainings for the G&A people, recruiting expenses to hire any G&A people. They're all going to follow here in this pool. But what I wanted to point out here is when you set up your G&A trial balance, I'd love it if you would segregate out your accounting, legal, and other professionals. As you can see here, I've got accounting, legal, and professional fees broken out. The reason is anytime you get audited, the auditors want to see the accountant's bills and the legal bills because there could be costs associated with services that would be unallowable. So making sure that you separate those makes it easier for you and for the auditor to look at them. And then any other consultants that you get, you can put in the other professional line and book them there. Bank fees, please make sure regular bank fees are allowable, but if you get a penalty because you bounced a check or if there's any late fees, those penalties or interest are all unallowable. You need to make sure that you pull them out and don't book them here in the G&A pool. So my G&A pool is coming up with an example of $1 million here. And I've also pointed out in here some examples of commonly unallowable type costs that you will incur in regular businesses. So interest expense, you're going to create it as a separate GL account, but a lot of times what I do is I put it in the 9,000 series, so it's at the end of my trial balance, and then I know those are unallowable. So for example, in here, I've got interest, contributions, officers, key man life insurance, penalties, trade shows. If you go to a trade show for a conference, if you attend to learn, go to attend the classes and it's for learning and for education, that cost would be allowable. If you go to put up your booth and say, hey, come check us out, we're doing a really great job, we do all these wonderful things, you should come and hire us or partner with us. That's what I like to call tooting my own horn. I'm advertising how wonderful I am. That's an unallowable cost. So if you put up a booth at a trade show, those expenditures all associated with that are then unallowable. You can have them, but they're just unallowable. So in this example, I've got $82,000 worth of unallowable cost summed up here. That means I need to make sure I make enough profit in the business that I recover that $82,000 because it's not going to be in my indirect rates. Credit card fees. So regular, if you have, for example, regular credit card fees, those would be an allowable because it's just a recurring business expense. If you have interest or penalties associated with those would be unallowable. Okay, so that was a good question someone asked about credit card fees. Do sub-consultants for work on projects for professional services contract fall in the G&A direct cost? So that's a great question. So subcontractors, if you're hiring consultants or subcontractors to do direct work on a contract, that's going to be a direct cost. If you hired, let's say, a consultant to be your part-time contracts manager, that's an indirect role in your company that would go in your G&A pool. So it really is, the question is, when I'm hiring a subcontractor or consultant, what work are they doing? Are they doing something that's a direct charge to a direct contract? Then you charge their cost direct. Always ask the question, what's causing this expense? Who's benefiting from it? It will help you figure out where that cost needs to go then. So that was a great question. Thank you. So then again, same example as we've done in the previous, we took the pool amount, divided it over the base to come up with my G&A rate. So if you'll see here, I've got subcontractors, consultants, materials, travel, other direct costs. They're all here in the base of my G&A because G&A pool is over everything else. So this example is a total cost input. You need to make sure you're accounting for all your costs in the base. And then that's how we come up with a G&A rate of 19.63%. Now, what I just did is talked through fringe, overhead, and G&A. So if you look at the bottom, you'll see there's a 3-tier rate structure, fringe, overhead, and G&A. That's what we call 3 tiers because I'm going to take my direct labor dollars and I'm going to burden it with fringe, with overhead, and with G&A. That's 3 of them. So that's why we call it a 3-tier structure. Now, if I treated my fringe as a service center, remember we were talking about those earlier where it's an intermediate pool, and it's going to go to the overhead and to the G&A pool, then that would be what we call a 2-tier rate structure because on my direct labor dollars, I'm going to apply overhead and G&A only. So since I'm applying 2 rates, it's a 2-tier structure. Okay. Fringe is just then it's included now in the overhead and G&A pool instead of by itself. I would say that's not a common indirect rate structure. Certain spaces and certain customers, it is. I would say most professional services will be 3-tier rate structure. Excuse me. And so the fringe overhead and G&A will be most common. There's also a single rate G&A structure, and this will be found, with construction companies or with manufacturing companies. They push everything direct. And then they only have a G&A rate that's left as the only rate left. Now, someone asked, would you choose one rate over structure over another? Again, it will make sense based on your customer that you deal with, the industry that you're in. If you do professional services, my personal preference would be 3-tier rate structure. At the end of the day, the cost will be the same in any of these structure, but I find that your rack rate will end up being lower in a 3-tier as opposed to a 2-tier. I only go to the 2-tier is if the customer all my customers are primarily in that space expecting it to look like that. Then if that's where my bread and butter is, then I would probably go that way. But otherwise, I traditionally will lean towards 3-tier. If, for example, you're starting out your business and you don't really have any fringe benefits, and you don't really have overhead, you might just have G&A, and that's okay if you start out with that. You may start out with fringe and G&A and not have overhead, but I would still call you 3-tier structure. You just haven't developed an overhead rate structure, but you want to build that in your infrastructure and your chart of accounts so that you can grow into that. So if you're on the smaller side and you're growing your business, you might start out with just fringe and G&A because maybe you give holiday and vacation to start out with and you pay statutory taxes. So you'll have fringe and G&A. That's fine. So again, a lot of it will lead towards you'll end up falling into a structure that makes sense for you, where you are in the space and where your business is growing. And really, you know what the answer is when you calculate the rates, can you sell it? And if it's not competitive, then you're going to look to go into a different structure. And as you grow your business and get even bigger, you can grow multiple overheads by locations, by different industry types. It could be on-site, off-site, because I've now got contracts working on my facilities as well as at customers and client sites. So you're not, even when you pick up one structure, you're not locked into it forever. So don't think that. As you grow and evolve, your rates will grow and evolve with you. So don't feel boxed into a specific structure. What I will tell you is the question I get asked a lot is, well, what are the competitive rates that I should be showing when I have these rates? So what I'll say generally for my small to mid-tier customers, their fringe rates run between 20 and 35%. So depending on how much benefits you're offering, the more robust, the higher your fringe rate's going to be. So if I have high-end people that I want talent that I really need to retain, and I'm trying to attract them, I might offer a lot of different types of benefits, including tuition reimbursement, maybe stuff like that. So the more benefits you give, the higher your fringe rate will be. Now, overhead, I put 0 to a question mark. This one is because this one trips up a lot of people. Because if you don't know what someone's rate structure is, it's very hard to compare apples to apples. So where I just mentioned a moment ago, a 2-tier structure versus a 3-tier structure, if I took the same cost, the rate for the overhead rate will be drastically different. In the 2-tier version, it will be much higher than it would in the 3-tier. So it's the same cost, but I just put it in a different format. So I feel like overhead doesn't give you the information you're looking for. Your fringe is the benefits for your employees. That makes the customer happy if you're making the employees sitting on the site happy, because then they're happy. Overhead is your management of the contracts, right? But G&A is the part where the government gets the most heartburn with. And that's where I would say when you're starting out in the business, you're going to be in the double digits. It's just, you don't have the base, you don't have the contracts yet, you're going to have a really high G&A rate. But as you grow and evolve, your goal will be to get it as low as you can into the double digits. So as you're growing, you want to be between the 10 and the 15% double digit G&A rate. But what I'll tell you is when you're going to look at the rates individually and say, okay, I want my fringes to be in the 20 to 35%, and I like my G&A rate to be as low as possible. But when you calculate your wrap rate, that's really where you're going to figure out whether I'm competitive or not. And here's how we're going to calculate a wrap rate. I'm going to go forward in today's discussion and go through using the three-tier rate structure since it's the most common one. So our example today is always going to be this three-tier rate structure. And what we're going to do is, as I've shown you, we've calculated the fringe rate in the earlier examples of 28.04%. Our overhead is 11.22%, and our G&A is a high 19.63%. And my wrap rate, which I'll show you how to calculate in a minute, I gave you before fee and if an example if I want it with fee. So wrap rate before fee is 1.7. What that means is for every dollar I pay an employee, I need $1.70 to break even. That is just break even. I didn't make any money. There's no profit. There's no fees. I'm not making money. And let's say I wanted to make an 8% profit margin on something, then I would use a wrap rate of 1.84. And this is important to know wrap rates because let's say you're not the only person doing business development. If you're talking to a customer, and this happens quite a bit, they'll ask you, okay, well, if I was going to add a person, how much roughly is that going to cost me? Then with the wrap rate, you can take someone's pay rate, figure out a quick and dirty number and say, okay, if we need somebody at this amount of pay rate for this number of hours, it would roughly cost you X number of dollars. That's real information to your customer in real time. So having your BD people knowing what the wrap rate is for each year, remember this is based on an annual budget numbers, this is going to be important information that you can share with your BD people so that they can share it when they're talking to customers. A question just popped up. Since you included money to the owners in the determination of the indirect cost, aren't you making money even with no fee on the wrap rate? No, because you will pay yourself. You cannot include costs paying yourself unless you actually pay yourself. Now, I know sometimes when you're starting out the business, cash flow is tight. So it's kind of like a vicious little circle. I want you to pay yourself, and unless you pay yourself, you can't recover the salary to pay yourself. But then cash flow might be tight. So if from time to time you cannot pay yourself because of cash flow reasons, you can record that guaranteed payment as deferred compensation on your balance sheet. But that doesn't mean you can leave it there for an indefinite amount of time. That means within a reasonable period, you still have to go back later and pay yourself. So within 3 to 4 months, they'd like to see that you paid yourself. Now, when you start out, you're not going to start out paying yourself a big salary just because the funds aren't there. But if you get in the habit of budgeting, so this is why it's important to budget what you want to pay yourself, right? If you don't put it in your indirect rates, you won't be able to recover it. If you put 0 as your compensation, you're going to get 0 back when your indirect rates. So in this 1.7 wrap rate, my break even accounts for me paying myself as the owner of the business. If I hadn't put it in there, my wrap rate would be even lower, meaning I'm never even going to bill back or recover costs to pay myself. I'm working for free. And that's why I want you to put in as an owner some guaranteed payments for yourself and then try and pay yourself so that you can recover it. Because when I go to bill this wrap rate later on, when I do the loaded bill rates, I'm getting a portion of my salary recovered that way. All right. I did want to mention about wrap rates, making sure they're really important in sense of like running your business and managing your business, is because if you don't know what your break even is, if you decide to take a contract and legally sign and binding agreement saying I'm going to do some work, if you don't know what your wrap rate is and you take it in at something lower than what your break even is, you're basically paying them money to do the work for them. And you don't want to do that. So I want you to know where your break even is and then what you want, is your budget for profit margins. Use that rep rate. If you have to come down a little bit sometimes on negotiations, that's part of being in business. I get that. But you just need to figure out, okay, 1.7 is my absolute bottom dollar. I want to be at 1.84. If I need to be at 1.8 or 1.79, fine. I lose a little bit on the profit margins, but that's okay. I'm still making money. I'm not doing it for free, and I'm not doing it where I'm paying somebody to do it. We don't want to get in that situation. So I want you to do a budget for that reason, to know where you are, where you're going, and then measure yourself throughout the year. And I'll tell you, for wrap rates, the competitive wrap rates are usually between 1.4 and 1.9, and it really depends on your industry. So if you are on janitorial services or help desk IT services, that's going to be on the lower end. We're not paying high compensations. We're not paying high salaries. So your wrap rate is going to be towards the 1.4 range. If I have highly skilled engineers or developers that are creating something unique, and I need high-end people with, let's say, masters and PhDs, those people are going to cost me more money, and there's going to be more benefits that I have to offer, and I have to pay a higher salary. That means my wrap rate is going to be on the higher end. So also, if you do people with clearances, I got to pay those people with clearances a premium, right? Those people come with an uptick of what, 10 to 12% premium on their salaries because they have a clearance already. So that automatically will put your wrap rate on the high end. So gauging where your business is and what types of services you offer, your wrap rates are going to be different because of that. So, paying attention to that is also going to be key for winning new work. So if you want to be competitive, make sure you understand your industry space that you're in, what types of services and employees I need to hire, and then knowing if your wrap rate makes sense and is in line with that. And, once you put together your budget, keep in mind, if you have to give a discount on a proposal, you can give a discount if you want, but you need to figure out and calculate how much dollars I'm not going to take. And someone asked, wrap rates for SCA tend to be higher because of higher fringe versus labor rates. You're absolutely correct. So if you're doing SCA type work, your fringe rate is dictated to you. The base pay is already dictated to you. The only thing left that's competitive is what is your overhead rate and what's your G&A rate. So that's what's going to determine who the winner is going to be, because it's usually going to be the lowest one that's going to win it. But if you have SCA contracts and other types of contracts, depending on how much work you have, like I said, you would create an SCA fringe rate that's only for those contracts, but all your other employees who are getting a different fringe rate will get a different fringe rate burdened onto them. So you can still be competitive in other spaces. Again, so you need to look at your wrap rates and look at your indirect rates so that makes sense for your businesses and what lines of businesses you're doing. I'm sorry, someone asked, what is SCA, Service Contract Act? So sometimes if you go bid on certain government contracts, there are certain ones where the government says this type of work requires a specific wage determination, and the Department of Labor will say for a welder, you have to pay them X number of dollars per hour. It's required by law, and you have to give them X number of benefits and holiday, and that's dictated under that type of contract. Not everyone. So unless you're dealing with SCA type work, or if you have union type work, you're not really going to fall into this area. But if you should have that type of work, they're dictated to you what you have to pay the people. So if you're just doing regular government contracting work, don't worry about it. It's not going to be in part of your space or in your contract, so you won't have to worry about it. And someone asked, how often does the government validate compliance with SCA requirements, and how is this done? That's a good question. So for Service Contract Act, really, and I don't want to get off on a tangent too much for this, but I'll just let you know, Department of Labor will make sure you paid the employees what they required for the wage determination. So at the end of the day, you will have to pay them what is required per their contract. They don't care whether you did or did not. They will make sure you pay that. And if they audit you and you did not, you will be cutting a big fat check to all these employees, even if it's many years later, because we've had people that didn't realize they had it, they didn't manage it correctly, it turned out bad for them, they had to cut a big check. So if you are going to get an SCA work, make sure you understand it, please. So you're going to pay it. The only other, then basically in terms of how you calculate it in your indirect rates, SCA doesn't care. The only thing they care, it's based out of Department of Labor, they care that you paid the employee what they're required. Other than that, they're not going to worry about anything else thereafter. Okay, good questions. Okay, so let's actually walk through how to calculate the rates, because this is the parts that I really want to get into. So keeping with the same fringe overhead and G&A rate that we had been talking about through today's webinar, I've got an example of here how you can figure out how to calculate your wrap rate using your indirect rates. So I've got $1, and I'm going to multiply it by my 28.04% fringe rate. That's going to give me 28 cents. So the sum of those two is then $1.28. That $1.28 means I'm paying someone $1 an hour to work plus 28 cents for their fringe benefits, right? And then I'm going to burden it with my overhead rate of 11.22, which is going to yield me another 14 cents for my overhead cost. So then I have $1.28 plus the 14 cents is going to give me $1.42. So at this point, I'm covering their hourly, dollar an hour pay. I'm recovering their fringe benefits, and I'm recovering my overhead expenses on that dollar at $1.42. Now I need to put the G&A cost on it at 19.63. That's another 28 cents. And then the sum of that gives me that 1.7 wrap rate that I told you was my break even. So this means at this point, all of my allowable costs, both direct and indirect, are now breaking even. I've just recovered all my costs. And in this example, I went with a 7.5% fee. That's another 13 cents. That gives me a 1.83 wrap rate. Now I want to show it to you in this manner so that you can see how it will look on a horizontal cost buildup. So I'm doing the exact same thing where I'm taking the dollar and I'm burdening it with my fringe, coming up with a subtotal, burdening it with my overhead, coming up with a subtotal, burdening it with my G&A, and I'm coming to my break even, right? Adding on the profit, and then I'm coming up with a wrap rate with that 7.5% fee on it. Okay, this is important because when you go to do pricing, I know this looks kind of tiny. This is what your pricing would look like. For example, if you had a labor hour contract that you were bidding as a subcontractor, or some type of time and materials, but with no M part, no ODCs. So I used Barbara and myself as the labor categories. So I put the employee name, I put the labor category we're proposing in, and I put our annual salary amount. So I'm going to walk through my line where it says Donna. I'm going to be paid $85,000 a year as a subject matter expert level 3. Now I need to calculate my hourly pay rate. So what I did is I took the $85,000 a year and I divided it by the number 2,080. So when full-time annual salaries are calculated, it's assuming the employee would work 40 hours a week. So that actually equates to 2,080 hours. And I have the note down at the bottom in case you forget. So the 85 divided by 2,080 gives me a $40.87 an hour pay rate. And this is where I'm going to do the buildup that we just did a moment ago. I'm going to take the $40 and I'm going to apply the 28% fringe rate. So it's $11.46 that's going to be added. So my subtotal is now $52.32. So great. Now I've got Donna's base pay covered, and I've got her fringe benefits for her holiday and her taxes and all that stuff covered. And then I'm going to apply the overhead rate. So my indirect support, managing the contracts and all that good stuff for the training and all that. I need to make sure I account for that. I'm going to put the 11.22% overhead rate. That's another $5.87 an hour. And that's going to give me $58.19. Now, of course, I've got to tack on my G&A because we've got to get executive management, the accounting department, the contracts department, all their salaries and the owner's salaries, everybody's got to get recovered through my G&A rate. So that's another $11.42 added on there. And then I'm going to get to my loaded break-even rate, which is the $69.62. So at this point, that's just how much, if I build her out at $69.62 an hour, I will break even, okay? And then, of course, we're all in this to make some money, right? And because I want to make some money, I'm going to burden it with a 7.5% fee. That's another $5.22 that's being added on there, right? Now I've got a totally fully burdened labor rate of $74.84. Now, this is what I want to bill my employee out at. Now, I'm going to propose the hours that they're actually going to work. So remember the 2,080 hours I was talking about? That's how an annual salary for a full-time employee is calculated. But that's not really how many hours they're going to work on a contract. The 2,080 hours accounts for the 10 holidays, maybe the 15 days of PTO that I give, right? So those are in my fringe rate. So I can't account for them again. I can't say another 2,080 hours because that's not realistic, right? So I have, in my example here, 1,880 hours. And that's me assuming 10 holidays, that's 80 hours. So you take 2,080 less the 80 hours. And then I've got 15 days of PTO, that's another 120 hours. That's how I get to 1,880. So depending on what your leave package is, your workable full-time hours can be different. So if I gave 20 days of PTO, 1,840 would be my billable hours. If I only gave 10 holidays instead of 15, it would be a different, I think it's like 1900 something it would calculate as. So you need to figure out what is it that your business offers as leave, and then making sure you're deducting that because it's accounted for in your fringe pool and it's in your fringe rate. So then the full-time hours would be 1880 based on my example here. And I'm bidding Barbara Morgan at 500 hours because she's the part-time subject matter expert 4. I don't need her full-time on the contract. So I can take her loaded bill rate times the 500 hours I'm expecting, Donna's loaded bill rate plus the 1880 hours. And then I get my total proposed value of $186,923.45. That's what I'm going to send to the government or to my prime contractor. Now, here's what I would call an unsanitized pricing. Now, if you are going to give something to a prime contractor, you would hide everything from annual salary to G&A. Those columns would be hidden. The only thing you should ever show a prime contractor would be the employee name, the labor category, the loaded rate, the fee, and the fully burdened, then the proposed hours and proposed cost. You would not show all of the proprietary information in the middle. That's confidential proprietary information. If a prime contractor should ever tell you that you have to show it to them, you do not, by the way. You could ask them to show you where it states that in the FAR. They won't be able to find it because it's not in there. But what you can do is say, I'd be happy to give a sealed package to the contracting officer. That's customary what you would do. So what you're going to do is make a detailed version like this. This would be what we call unsanitized, goes in a sealed package. You can give it sealed up and put for government eyes only, and your prime contractor will then deliver it to the government to them to open it. You would give your prime contractor only the unsanitized portion, which would be just the name, employee name, category, and then start picking up where the yellow is loaded labor rate. Fee, by the way, fee is not proprietary. That's usually discussed if you're a subcontractor, when you're on a team, that's usually negotiated in advance. And if not, then put on whatever fee you think is reasonable for the type of contract you're bidding. And then you would propose the hours and come up with your cost. So this would be customary in your pricing when you're doing it as a subcontractor or a prime. All right. Then I wanted to show you when we did that wrap rate earlier, if you had to have your BD guys do a quick calculation, here's how it would work. So for example, a COTAR wanted to know how much it would cost to add another person on the contract as a subject matter level 3 expert. And that person's salary is going to be projected at $85,000 a year. Well, again, I'm going to take the $85,000 a year. I'm going to divide it by that number of 2,080, because that's how salaries are calculated. And then I get the $40.87 an hourly pay rate. That's what I'm going to pay my employee. And then I'm going to apply those wrap rates that we talked about and calculated earlier. 1.7 was my break even, and 1.83 was with my 7.5% profit margin in it. And then what we did is this would be a full-time employee. So you could see if I build this employee out at $130,000 a year, I don't make any money. But if I bill them out at $140,000 a year, I get almost $10,000 profit margin. That's how much profit I would make in dollars on that employee for the entire year at a 7.5% fee. Okay. So this is kind of how those wrap rates work out. When you're doing pricing, I want you to do it this way because it's much more accurate. But if you have to do a quick and dirty, this is how you're going to do the quick estimate to get to a rough estimate of how much it's going to cost. It's pretty close to the cost buildup. It's just off for rounding purposes because Excel rounds out much further and it's much more accurate. So that's the only reason why you get differences on here. All right. I know we have a lot of questions, so let me try and answer some of them. Let me scroll up here. Do companies' work years impact calculations? Okay, so does the company's number of years impact how they calculate the billable hours that you work? So no, it's based on your leave that you offer. So again, if you have to look at I want you all to sit there and say, okay, right now, take the number 2080 and put it on your paper. Then I want you to tell me how many holidays do you give as part of your benefits? Okay, so most people will follow federal calendar or whatever on somewhere between 8 to 10 days off, right? For holidays, usually 10, right? So then that would be less. 10 times 8 hours a day is 80 hours, okay? Then I want you to answer how many vacation or sick, or whether you offer PTO, how many days off do you give for that leave? Take that number of days times 8 hours and put that there. And then I want you to take the 2080 minus the number of hours for the holiday, minus the number of hours for your vacation. That is the maximum amount of hours your employees would work on any contract. Okay, that's how you come up with it. That's for proposals. That's how you come up with the hours you would bid. Okay. All right. How do we they're going faster. How do we calculate this when we will have to hire people, execute a contract? We don't have prices to calculate the fringe. So when you're trying to figure out how you're going to do pricing, you need to figure out, if I'm hiring someone for a specific labor category, go do some salary surveys, figure out how much it's going to cost to hire that person. And when you're building your budget, I want you to think of your company and your business as a whole for the entire year. So make assumptions that you're going to hire employees. Figure out, I'm going to hire an employee at $80,000 a year. Put it into your cost structure and bid that out so that you can figure it out how to do how much it's going to cost you to have employees that much. So at whatever salaries you think is going to be reasonable for the industry and the position you're hiring. So I know we've got a lot of questions that we can't get to on today's webinar. I'm going to go through the questions later. Donna will send them to me, and I will write up responses for the questions, and we'll get them back to you. I'm going to turn it over to Barbara now.
Thank you so much, Donna. That was an excellent presentation on indirect rates and what you need to know. And thank you for your willingness to answer all these questions.
Of course.
We'll make sure you get those. And I think there's still even more questions coming in. I wanted to remind everybody that today's presentation will be sent to you, and it is also video or audio. You'll have the audio as well as the slides, and we're also going to put them on our website in case you could not stay with us the whole day, or if you wanted to share it with an employee that could not join you today. I want to thank you to our participants for attending the VIP webinar, and to the SBA for making this webinar possible. Again, we hope you found the information presented to be helpful as you prepare your company to be compliant and competitive.
Yes.
I would like to ask that you also take a moment to complete the very short survey that will be sent to you immediately following this program. Your feedback is always very important to us, and we do take a look at your comments. Thank you, and we want to thank Donna Dominquez again for her taking her time today as our VIP instructor in the classroom and on as a webinar. Thank you to everyone on the webinar today, and we wish you continued success in 2018.
Absolutely. Thank you.
Have a great day.